now, the housing market feels stuck. With mortgage rates hovering around 6.5%, a lot of active buyers are hitting the pause button on their search. It is a logical defense mechanism. The thinking is that if you wait out the market for a year or two, rates will eventually drift back down to 5.5%, making the monthly carrying cost much easier to handle. But real estate brokers are circulating a very different perspective, one that suggests waiting for those lower rates is actually a high-stakes financial gamble. The claim is specific. If you delay the purchase of a $328,000 home by 2 years, your total equity position in 2028 will be exactly $27,846 lower than if you bought today. They call this the hesitation gap. It's the cost created when the money you save on a lower interest rate is swallowed up because the price of the home itself kept moving up while you were waiting. To find that $27,000 penalty, you have to look at the total equity you'd build over 24 months. By buying now, you capture $23,000 in appreciation and $6,000 in principal paydown. Even though you'll eventually have to put more money down for a more expensive home in the future, the head start you get today creates a massive gap in your net worth. This math presents a major dilemma for two types of buyers: the anxious sideliner, who is worried about the monthly bill, and the wealth optimizer, who is looking at the long-term balance sheet. A blanket rule to buy now affects these two groups differently because their ability to realize these gains depends entirely on the cash they have available to weather the current rates. We are going to stress test this math to separate the marketing spin from the actual financial reality, looking at whether timing the market is a strategy or a trap. Let's look at the baseline. We are analyzing a $328,000 purchase with a 10% down payment. Here is the head-to-head. Buy today at 6.5% and immediately capture $23,362 in appreciation and $6,820 in principal, committing to a $2,413 payment. Wait 2 years for a 5.5% rate, and the house rises to $351,362, neutralizing your savings. The entire argument for buying now relies on one factor. Is a 3.5% annual appreciation rate actually realistic? This chart from Freddie Mac puts that into context. Looking back over the last 50 years, the national average for home appreciation is actually 5.02%, meaning that 3.5% assumption is actually quite conservative. While individual years vary, national home values have only declined 7 times in the last half-century. The historical data suggests time in the market is a much more reliable wealth builder than trying to perfectly time a dip in interest rates. However, the spreadsheet doesn't tell the whole story. We have to look at the mechanical costs of buying now, starting with your down payment. Because a 10% down payment leaves you below the 20% threshold, you'll be hit with private mortgage insurance, an extra $111 a month on top of your mortgage. The trade-off is that the appreciation from buying now could help you reach that 20% equity mark and drop the PMI in about 2 years. If you wait, you're starting the clock for that equity build from scratch in 2026. This brings us to the industry mantra: marry the house, date the rate. The strategy assumes you buy today, accept the higher rate for now, and then refinance in year 3 once rates hit that 5.5% target. But you have to account for the fact that refinancing is a new transaction. You'll face thousands of dollars in new closing costs and origination fees, which eats into that $27,000 equity lead. Even after subtracting those refinance fees, math still shows a measurable advantage for the buyer who moves now rather than waiting for the market to cool. The numbers favor buying today, but the math only works if you can afford the monthly reality of the loan until that refinance happens. Equity is a future gain, but the $2,413 mortgage is a today expense. Buying now is only a winning move if you can handle that payment without draining your emergency savings or defaulting. To decide, use this filter. Can you comfortably afford that $2,400 payment right now without relying on credit cards to make ends meet? If the answer is no, you are the anxious sideliner. Your trade-off is simple. You are choosing to pay a higher price for the house later in exchange for financial survival and peace of mind today. Ignoring your monthly cash flow just to chase theoretical equity gains is the fastest way to end up in a foreclosure situation. But if you can afford it, look at the second filter. Are you staying in the home for at least 5 years? If yes, you are the wealth optimizer. You have the cash flow and timeline to wait out minor market dips. For you, the trade-off is clear. You accept a higher interest rate for a short window to lock in over $20,000 in highly probable appreciation and paydown. The biggest obstacle is the psychological pressure of waiting for the Federal Reserve to signal that the market is safe. Don't let FOMO push you into a mortgage you can't afford. But if the capital is there and the numbers work, the math says you should stop waiting for a green light that has already been lit for decades.